Okay, so you want to own a central bank. Print the money, set the rates, watch governments come to you with their hat in hand. Here's the strange part. A central bank is the only institution on earth where you can manufacture the thing everyone else needs to survive and charge them for the privilege of using it, and it's also the institution where the people running it are technically not allowed to profit from it. Technically. By the end of this video, you'll know exactly how central banks actually generate and distribute billions in profit every year, why independent institutions still answer to someone, and why the most powerful financial entity in any country is also structurally designed to be nobody's property. So first, what does it actually cost to get one of these? You don't buy a central bank. You charter one. The distinction matters. The U.S. Federal Reserve was chartered by an act of Congress in 1913. Cost to set up the legal framework, the initial capital subscriptions, the staffing, the vaults. Roughly $143 million in today's dollars. For that, you get the exclusive right to issue the national currency, hold the government's deposits, and set the interest rate that every other rate in the country is built on top of. The 12 regional Federal Reserve banks are technically owned by member commercial banks, who are required to subscribe capital equal to 6% of their own capital and surplus. Currently, JP Morgan Chase holds the largest single subscription. They do not control policy. They receive a fixed 6% annual dividend on their paid-in capital. That's the arrangement. Now for the obscure comparison. The Riksbank of Sweden, the world's oldest central bank, was founded in 1668 for the equivalent of about $2 million today. It was originally a private bank that lent money to the Swedish crown. The crown nationalized it 50 years later when it became clear that whoever controlled the money supply controlled everything else. Even the most absolute monarchy on the continent eventually understood that the bank was the actual seat of power. And then there's the peculiar case of the National Bank of Libya under Muammar Gaddafi. After 1969, Gaddafi restructured the central bank to directly fund government spending without issuing sovereign debt. No bond market. No external creditors. The bank printed to spend. By 2010, Libya had $150 billion in sovereign reserves, zero external debt, and a central bank that functioned as a direct fiscal arm of one man's government. The IMF considered it an anomaly. It worked until it didn't, and then it was a war zone. The lesson isn't that the model failed. The lesson is that a central bank's independence is precisely as durable as the political stability around it. Now, where does the money actually come from? Imagine you own a bakery. But instead of selling bread, you lend flour to every other bakery in town, and they have to pay you back with slightly more flour than you gave them. You never run out of flour because you're the only one with the mill. Every transaction in the entire baking economy passes through you. That spread, the difference between what you lend and what comes back, is yours. Every year. Forever. That's seigniorage. And it's the core revenue engine of every central bank on earth. Here's how it works in practice. The U.S. Federal Reserve creates money electronically and uses it to buy government treasury bonds. Those bonds pay interest. In 2022, the Fed earned $170.8 billion in interest income from its portfolio. After paying its own operating costs about $7.4 billion, and paying the statutory 6% dividend to member banks, it remitted $76 billion back to the U.S. Treasury. That remittance is the Fed's profit, returned to the government that chartered it. In a normal year, that number runs between $50 billion and $100 billion. The European Central Bank runs the same model across 20 countries. In 2022, the ECB and the national central banks of the Eurozone distributed €5.4 billion in profits to their respective governments. The Bundesbank alone handed €2.4 billion to the German federal government. Nobody calls it profit. The technical term is seigniorage income. The math is the same. One number that puts this in perspective: the Bank of England has been operating since 1694. In 330 years, it has never posted a loss on its core currency issuance operations. The house edge on a monopoly currency is, it turns out, fairly resilient. Here's what most people miss entirely. The casual observer looks at a central bank and sees a boring regulatory body. Meetings, statements, interest rate decisions. That's the public layer. The real layer is the balance sheet. The Federal Reserve currently holds $7.4 trillion in assets. U.S. Treasuries, mortgage-backed securities, short-term instruments. That portfolio was $900 billion in 2008. It grew by $6.5 trillion in 16 years through a process called quantitative easing, where the bank buys assets by creating new reserves. The assets earn interest. The reserves pay interest to the banks holding them. The spread between those two rates, multiplied across trillions of dollars, is the operating margin of the most profitable financial institution that most people never think about as a financial institution. And then there's gold. The Federal Reserve Bank of New York holds approximately 6,000 tons of gold in a vault 15 meters below street level in Lower Manhattan. Most of it belongs to foreign governments. Germany alone stores 1,236 tons there, worth roughly $95 billion at current prices. The storage fee is nominal, a few basis points. But the political leverage of holding every major government's gold reserves is not nominal at all. That's not an asset on the balance sheet. It's infrastructure for the entire global financial order. The thing that sounds like a conspiracy is just geography. One building. 6,000 tons. Now, why do central banks fail? They do. Not often. But the failures are instructive. First mistake: monetizing government debt until the currency collapses. Zimbabwe's Reserve Bank, under pressure from Robert Mugabe's government, began directly financing fiscal deficits in the early 2000s. By 2008, the money supply had grown so fast that inflation reached 89.7 sextillion% annually. The central bank printed a $100 trillion note, which at peak inflation was worth about 40 US cents. The bank technically still existed. The currency had ceased to function as a currency. Final cost: the complete destruction of the Zimbabwean dollar, a forced switch to the US dollar in 2009, and the erasure of decades of household savings across an entire country. The bank didn't go bankrupt. It went irrelevant. Same outcome. Second mistake: defending a fixed exchange rate with insufficient reserves. In 1992, the Bank of England was defending the pound's position in the European exchange rate mechanism at a floor of 2.7 Deutsche Marks. George Soros identified that the rate was unsustainable. He borrowed £10 billion worth of pounds and sold them short. The Bank of England spent $27 billion in reserves trying to prop up the rate in a single day, September 16, 1992, now called Black Wednesday. By 10 p.m., Britain withdrew from the ERM. The pound fell 15%. Soros made $1 billion in profit in 24 hours. The Bank of England lost $3.3 billion of public money defending a rate that the market had already decided was fiction. The lesson: a central bank's balance sheet is large. A determined global capital market is larger. So what does this actually pay? Two scenarios. Real numbers. A small central bank, say the National Bank of Cambodia, manages a balance sheet of roughly $21 billion, mostly foreign reserves and domestic bonds. Annual seigniorage income runs around $200 to $400 million. After operations, it remits $80 to $150 million to the government annually. Not glamorous. Sufficient to fund a significant portion of a small nation's budget. Recession-resistant in the same way a toll booth is recession-resistant. People need the road. A large central bank, the Federal Reserve, manages $7.4 trillion in assets. Peak annual remittance to the U.S. Treasury: $109 billion in 2021. Average annual remittance over the last decade: roughly $65 billion. That's more than the entire GDP of 100 countries, returned to one government from one institution every year without selling a single product. And then there's the historical case that clarifies everything. Mayer Amschel Rothschild built a banking dynasty in the late 18th century specifically by positioning his 5 sons as financial agents to the governments of England, France, Austria, Naples, and Prussia. By 1825, the Rothschild family's combined wealth was estimated at the equivalent of $1.5 trillion in today's dollars, making them arguably the wealthiest private family in recorded history. They didn't own central banks. They did something more durable: they became indispensable to the people who did. The most powerful position in the entire system isn't owning the bank. It's being the one the bank calls when it needs something.